Decoding the human element, the role of behavioral finance in investment decisions. Introduction. In the fascinating realm of investment decisions, numbers and financial models often take center stage. However, the human element, driven by emotions, biases, and psychological quirks, plays a profound role that cannot be overlooked. Enter behavioral finance, a field that seeks to unravel the mysteries of human behavior in the financial domain. Understanding how behavioral finance influences investment decisions is paramount for investors striving to navigate the intricate terrain of the markets. Behavioral biases unveiled. At the core of behavioral finance are the cognitive biases that shape human decision-making. These biases, often ingrained in our psyche, can lead investors astray, deviating from rational and objective choices. Anchoring bias, where individuals fixate on specific reference points, and confirmation bias. The tendency to seek information that supports pre-existing beliefs are just a couple of the many cognitive pitfalls that investors encounter. Consider an investor, captivated by a stock's historical high, who becomes anchored to that peak price. This anchoring bias might prevent the investor from recognizing the stock's current overvaluation or deteriorating fundamentals, leading to decisions based on an outdated reference point rather than current market conditions. The herd mentality. Behavioral finance sheds light on the pervasive influence of the herd mentality in investment decisions. Investors, driven by the fear of missing out, FOMO, or the desire for safety in numbers, often follow the crowd rather than conducting independent analysis. This herd behavior can result in market bubbles, where assets become overinflated due to collective irrational exuberance, or sharp sell-offs triggered by panic-driven mass exits. For instance, during the dot-com bubble of the late 1990s, investors flocked to technology stocks, driven by the collective belief in the endless potential of internet-based companies. As the bubble burst, those who succumbed to the herd mentality faced substantial losses, emphasizing the significant impact of collective behavior on investment outcomes. Loss aversion and risk tolerance. Behavioral finance delves into the phenomenon of loss aversion, where individuals experience the pain of losses more intensely than the pleasure derived from equivalent gains. This aversion to losses can lead investors to make suboptimal decisions, such as holding on to declining assets for too long in the hope of a rebound, rather than cutting losses and reallocating capital more prudently. Understanding risk tolerance is another crucial aspect of behavioral finance. Investors may perceive and respond to risk differently based on their individual psychological makeup. A risk-averse investor might shy away from potentially lucrative opportunities, while a risk-seeking investor may expose themselves to undue volatility. Behavioral finance recognizes that risk tolerance is a dynamic factor influenced by emotions, experiences, and market conditions. Overconfidence and hindsight bias. Overconfidence, a prevalent cognitive bias, can significantly impact investment decisions. Investors exhibiting overconfidence tend to overestimate their abilities, leading to excessive trading, speculative bets, and a reluctance to heed advice or consider alternative viewpoints. This overestimation of skill can result in poor investment outcomes as individuals overcommit to their own predictions. Hindsight bias, the tendency to perceive past events as having been predictable after they have occurred, is another cognitive hurdle addressed by behavioral finance. Investors succumbing to hindsight bias may believe they could have predicted market movements or specific events. leading to overconfident decision-making based on an inaccurate assessment of historical outcomes. Emotional roller coaster and market swings. The emotional roller coaster of investing is a focal point in behavioral finance. Market swings can evoke a range of emotions, from euphoria during bull markets to anxiety and panic during bear markets. Understanding how emotions influence decision-making is essential for investors seeking to avoid impulsive actions driven by short-term market sentiment. For instance, during a market downturn, fear and panic may drive investors to hastily sell off assets to avoid further losses. Behavioral finance recognizes that emotions can cloud judgment, prompting investors to deviate from rational, long-term investment strategies in response to short-term fluctuations. Behavioral finance strategies for investors. Recognizing the impact of behavioral biases on investment decisions, investors can adopt strategies to mitigate their influence. Building a well-diversified portfolio, setting predefined investment goals, and maintaining a long-term perspective are effective ways to counteract the detrimental effects of short-term emotional decision-making. Additionally, incorporating systematic approaches such as dollar cost averaging, which involves regularly investing a fixed amount, can help investors navigate market volatility without succumbing to emotional swings. Embracing a disciplined and rules-based investment strategy can act as a buffer against impulsive actions driven by the whims of behavioral biases. Conclusion. In the intricate tapestry of investment decisions, behavioral finance emerges as a key protagonist, revealing the profound impact of human behavior on financial outcomes. Investors who delve into the nuances of cognitive biases, emotional responses, and the psychology of market participants gain a deeper understanding of the forces at play in the financial markets. Armed with this knowledge, investors can navigate the ever-changing landscape with greater resilience, making decisions that are informed by reason rather than swayed by the unpredictable currents of human behavior. As the field of behavioral finance continues to evolve, its insights serve as a compass for investors, guiding them towards a more thoughtful and measured approach to the challenges and opportunities that define the world of finance.